You're listening to the Practical Wealth Show with Curtis May, putting you in the driver's seat to control your finances. Let's start the Practical Wealth Talk about alternatives to Wall Street.
So today I've entitled this show, "What Should You Be Investing In?" And so this is prompted by, so let's think of this as a frequently asked questions show, because I've got a few calls in the last couple of weeks, referrals, people on my list. So here are the questions I get. So here, think about, you may ask these questions, so I'm going to answer them. I heard the market is down. Is this a good time to start investing? Okay. I've got 5, I had a 10, I had a $50,000. I've got some money, I want to start investing. Do you have any recommendations? Okay. And, what people are saying is, so that question to me, you're never going to get a straight answer. And anybody that does give you a straight answer, run. Because if you, like one of the things I always tell people is 3 types of money, right? There's accumulated money, which is if you have some money, you've accumulated some money and you want to put it, you don't leave it in a bank account, you want to put it to work, invest. So I get that. You've got lifestyle money it takes to run your household, do what you got to do, pay your bills, and you got transfers, money you're losing unknowingly, unnecessarily. So my overriding philosophy is that there is more opportunity to minimize the losses in your life. They're trying to pick winning investments. Okay. So the first thing that I want to know is I want to see the story of your numbers. So here's what you need to know. So before you do that, because investing is a plan, it's not products. So if somebody is with accumulated money, here's your typical advice from typical advisors. It's how much you got. We can do better. Why don't you move that money over here to us? And it's generally a product solution, right? And so, but you're putting up 100% of the money, taking 100% of the risk to maybe make 15, 20% of the profits, which is not me. That's Jack Bogle talking about mutual funds. And most people are talking about mutual funds, right? They're talking about stocks. They're talking about, I get a lot of questions around Bitcoin. I only know one person personally that I think is knocking it out of the park with Bitcoin. But he's trading. He's not, a sucker just hoping it goes up, buying into it because you heard it's going up. Or I remember when gold was hot, people was like, I want to buy some gold. It's like, really? Why? Because it's going up. Well, here's some homework, and I made him go buy Mike Maloney's book, Rich Dad's Guide to Investing in Gold and Silver, so you can understand why things happen. His whole book is about history of money, fiat currencies, so that you know what drives gold and silver up. If you're on that topic, a good book on that is A New Case for Gold, and check out our podcast with Peter Hugg on that. But so you got to know why things are happening, right? So let's start with this. So there's 4 asset classes. So when we talk about investing, the first thing I want to know is, how's your liquidity, right? Are you saving? Do you have more? I want to kind of see the state of the union, so to speak, before I'll talk about anything. So a question to me like that will generate 3, 4, 5 other questions. Okay. Because I don't know you. I don't know what you should be doing. I don't even especially, I don't do security. So I don't, that's what people consider investing. See, but investing is bigger than that. That's just a industry trying to control everything. So their mind makes you think that's investment. Prosperity economics, which we're a proponent of, is more so about how to be in control of your personal economy and buying assets that send you a check. I don't know if you read Rich Dad Poor Dad, but think about I want you to look at and this is what I would do with you if we were talking. I would say, okay, tell me about, what's the goal? What are you trying to accomplish? What do you want to invest for? Because money is to do something, right? And so if you're just putting money in something you don't understand, you don't know how it works, you are not investing. You're speculating. You're gambling. And so just understand, if you're going to gamble, all right, just don't gamble with more than you can afford to lose, right? Because the first thing I do with people is I say, okay, look, first of all, let me tell you, when Curtis says investment, okay, if that comes out of my mouth, here's what I'm talking about, okay? And I actually took a picture of this. I was in the bookstore and I went into Benjamin Graham's book, which is Warren Buffett's mentor, the Intelligent Investor. And in his book, I can't find the saved it somewhere, but basically in his book, he says an investment operation is one by which you put your money into it and your principal is safe and you have a reasonable opportunity to make a profit. Anything other than that is speculation or gambling. All right. So let that sink in for a second. And ask yourself, all right, do the things I'm doing now hold water with that definition? Is your principal safe? That means you put in 10 grand, 50 grand, 100 grand, your principal safe. Because if it doesn't do that, you're gambling. So is your 401k work that way? Or does the mutual funds work that way? Not saying you shouldn't do them, but I'm saying ask yourself that question. See, you have to lead your wealth. See, one of the things with Prosperity Economics, we teach people like, you are your most important asset and you are your best financial advisor. See, most people are taught you're not smart enough. You don't have the time to train to personally manage your own money. But 2 + 2 is 4, guys. It's not that deep. So the first question I ask you is, all right, do you spend more or less than you make? Right. So if you look at your cash flow, if you're cash flowing, $5 grand a month and your bills are $3 grand a month. Okay, great. Well, how much of that are you saving? So I want to see the flow of savings into, liquid cash. See, we use the acronym. The first money you got to save from income and invest from assets. So most people, you got 5 or 10 grand. The people that I'm talking to about that, so listen, the only one I can do that 50, I could do something with. And even then, because most of the investments or the opportunities that are out there that, where you have an ability to achieve, some decent, safe returns, high single digit or low to mid double digit returns and sleep at night you need, $25,000, $30,000. But most people aren't liquid. And so what you want to do when we teach them money for life is to, I want people to fund their banking system first. So you need a bunch of money, more than you think you need, where you've got control, liquidity, use, and equity. And then from your savings, you now employ your capital. So you don't need to stay fully invested. You need to, people say, I want to buy real estate. All right. What books have you read on real estate investing? What courses have you read on real estate investing? Do you have a mentor? Oh no, I'm just going to go down to the sheriff's sale and I'm going to, bid on some houses. Okay. Let me know how that works out for you. Now, some people can just bull their way through and figure it out, but most people don't have enough money to make mistakes like that. And so, your first investment is in your education. So your number one asset is you, and in that asset, your mindset, your skill set, and your network, and expanding your perspective, your why. So if, are you reading 10, 12, 15 pages a day? Okay. Now, I know I'm not talking about investment, but that's what you want a quick hit. Everybody wants to make a quantum leap and they want to hit a home run. And, you need to get some singles first, right? And so now, because investing is a plan. So what is the plan? What are you trying to do? Do you want to become financially independent, which is a function of cash flow? So what is financial independence? The definition I always give is Jim Rohn's definition of you can live like you want to live from the income thrown off by your personally invested asset. What's an asset? Something that puts money in your pocket every month. Okay. Like real estate, like a business. You got a laundromat, you got an ATM machine, you got things that throw off cash flow. And when you have sufficient cash flow to pay your bills without your labor, you are financially independent. And so what you've done is you bought your life back and now you can begin to really, you got time to look at bigger and better deals. Okay. So the first step is to become financially independent. And so is where so most people, when I look at their debt is not right. They don't have any liquidity. So I want to make sure that you have enough savings because stuff happens. And so if you lock money up in things, you put a barrier up, you lose ability to access opportunities, but now you've put your money into a box that you can't touch without penalties, which depending on if you want to create wealth and be an active investor, you need to be in control, liquidity, use, and equity, right? And so with these people, I'm like, well, what's the goal? Because if you're investing for cash flow, once you determine what you're trying to do, that kind of dictates where you put your money. Okay. Because most people are investing for hoping the market goes up. It's basically you're investing for capital gains. You're buying at X price, $20, and you hope when you retire, it'll be at Y price, $50. And I call it the greater fool theory. You're hoping that you get at one level, buy low, sell high, and you're hoping some fool will buy it from you when you're ready to retire, so you can convert that money from the sale, which now you've, by the way, had to liquidate the investment to turn that money back into cash. So you're, killing the goose, so to speak. The goose that lays the golden eggs, the investment. You just killed the goose to eat one time where it was laying eggs for you, especially if you're producing cash flow. And so, you have to decide what you're trying to do. So I would argue, remember we talked about, and I'll just remind you if you're new to the show, what are the 4 asset classes? So it's 2 things. It's you got to save money, save from income. So now what can you do with savings? There's 5 things you can do with savings. You can save your savings. You can consume your savings, spend it. You can lend your savings, or you can invest your savings, or a combination of the 4. So, but you've got to have the savings first, which means that you've got to underconsume. First, you got to make money, right? How do you make? And so before that, I was talking to this class last week. Before you make money, what do you have to do? You have to, because a lot of people don't start farther enough back. You have to create value in the marketplace in exchange for what somebody will pay you for that value. And now that value hits your personal economy. Now you've got to, richest man in Babylon, part of all your earnings yours to keep. You've got to store some of that value. And so if you have money for emergencies and or opportunities, most importantly, opportunities, then you've got to make your goal multiply by investing or lending your savings. So lending, there's things out there called bridge loans where you can loan money to, let's say, real estate investors or business owners. You create a promissory note and they pay you, 6, 8, 10% interest. That's the bank. That's how banks make money. So you got to learn to be the bank, and they've got collateral, and they're not taking risks. They've made you look at your credit report. They've got your properties collateral. That's how you got to invest. Okay. And that's not even investing. That's lending. All right. Investing is, I always use, Chris, the ATM example. He took his savings. He found about, I'm going to try to get Carrie on the next couple of weeks. One of the people I know that does this as a course, and you're able to buy these machines. They're a couple $1,000s a piece, and that's an investment. If you're collecting $250 per fee, and you do 100 transactions a month, that's $250. So that's a $200 is $2,400. Well, the machine costs $200. So if you can average that, you've got your money back in a year. Okay. And so after that, what's the ROI on that? That's a business. So the 4 asset classes are business, real estate, paper, and commodities. So most people, when they think investing, they're just in an asset class I call paper, right? Paper. Stocks, bonds, mutual funds, annuities, right? But paper, now I'm not saying you should do all these things. I'm saying this to expand your knowledge of what paper is. Paper. Tax lien certificates. There's a great book called The 16% Solution. Look it up. I heard about it first from Rich Dad Poor Dad. I had a book on notes, but there's notes. There's factoring, buying into factoring. There's, what is that book? I'm trying to look at my bookshelf. There's a whole thing on factoring and notes. But so how do you learn about this stuff? You've got to invest. There's people that buy distressed mortgages, right? There's private lending, life settlements. Those are all what I would consider we talked to Kevin on life settlements. So we've got a show on life settlements. So what happens is you've got to do your homework. Okay. But some of that, you got to have some money. So you've got to save some money. So really your best investment is if you want to, if you look at the Forbes 400, the people that get out the rat race, none of them, very few of them, I won't say none, that's a broad statement, got there by maxing out their 401k, and they didn't get there by risking in the stock market, what they've done is they built businesses. Why? Because you can control cash flow, control a business, and then they buy real estate. And if you look on the Forbes 400, they own one of those two asset classes. Now, they may hold some in paper, but they don't use paper as the vehicle by which they got there. So the four asset classes: business, real estate, paper, and commodities, right? And so what happens is most of them get there via business. So I would find some enterprise that you like. I don't care if it's Amazon, it's drop shipping stuff from Alibaba. See, most times you don't need money. You need a cash machine. Now, I'm not talking about your dream. I want to open a homeless shelter for battered women. I mean, that's later. You need to figure out a way to make an extra $300, $400, $500 a month, so you have money, so you can accumulate some money, so you have some money to put some money in other assets that make money. So that is where I would have you start. Okay. And so what should I invest in? Well, you got to figure out what is your, can you do anything that generates short-term gain? Most people are too illiquid, and I want them to build up their liquidity first. And then generally I want them to educate. So in our process, investing is like step 4, right? Which is when I look at your situation, what I'm looking at is, are you adequately protected? Are you got to play defense. So defense is insurance, life insurance, disability insurance. Your stuff needs to be covered, liability, depending on what you do. So you got to have a foundation, right? It's like building a house. 2, I want to make sure you have emergency funds. I want you to have ATM money that you can access with your ATM card or bank account. So that's a few $1,000 a month or 2 of cash. 3, then I want you to have serious cash, 3 months, 6 months, 12 months. That is now, after about 3 months, it's your opportunity fund. So we call that the vault. That's the private reserve strategy. That's where we want to store our liquid cash. Now you can make your dollars do more than one thing, right? And so now you can use your savings as collateral and go buy a laundromat, or use it as a down payment for a property, or get into turnkey real estate, or start. I've got a client that spent $3,500 on a cleaning franchise, and he's been able to knock it out the park, leave his job, and has 15, 20 accounts and 10 people working for him, and he's not even 32 yet, and making 6 figures. So there's a lot of ways to get this thing done. And so sometimes you got to think. So, I would say, hey, let me just blindly hand my money over to some fund manager and then hope the market goes up. Although that's what they'll do. I've got some money with a client that's came in some money. He's got a bunch of money sitting in the bank right now. And these advisors at the bank are like, hey, come in, let's talk. Let's da-da-da-da. And I told him, I said, look, what they're going to talk to you about, we're just taking our time, looking at what are your goals? What should you do? And so I'm walking them into it slowly, right? And it's like, all right, but here's what they're going to talk about. All right, well, the only thing they can do is what? I got mutual funds, I got variable annuities, I got CDs. So it's all product-based. There's no knowledge, no advice. There's nothing to understand. Okay, we're in the longest bull market ever, right? So we're at the top of the market, right? And so this is where you got to understand. If you go on to YouTube, look on my video called Demographics, you got to understand, see, if the market is predicated upon your investment for capital gains, right? So now most of mutual fund money is in qualified plans, right? IRAs, 401ks. So now what happens? There's systemic risk built in that they don't even talk to you about. So at 7.5, what happens? What has to happen? There's something in the qualified plans called RMDs, required minimum distribution. So if you got 10,000 baby boomers turning 65 every minute or something like that, then what happens is when that reaches critical mass and you have all of these people selling stock, and yes, the millennials is as big a generation, but they don't have as much money. So if they're selling, somebody's got to be on the other side of that trade, okay? See, because the stock market is a secondary market. See, the money is made by the companies. Yeah, I know a lot of mutual fund salespeople don't even understand this. Most of the stock market is a secondary market, right? And so you're just trading money back and forth between y'all. The money that the company raises is made in the IPO. And so when the companies are doing stock buybacks, they're just doing financial engineering so the CEOs can get paid on stock purchases, so they don't have to take all their money as earned income. And check out Robert Kiyosaki's book, Why the Rich Get Richer. And it's because I didn't understand why in the world, how does that help the company that buy their stock back? I could never understand that till I read that book. It's just a bunch of financial engineering. And so once you understand, we don't have honest markets, we have Federal Reserve induced asset bubbles. Okay. So, but if you make your money just, hey, put your money here, then, you know, as these people, they make money under assets under management. They don't tell you that, hey, these things could go down. There's forces at work that could make these things go down. And so if you don't understand that, you're guessing. So I'm telling you, there's systemic risk in that thinking. If you have all your eggs in that basket, that's, you know, in my opinion, that's what I'm doing. So again, don't take any of this investment advice. This show is for educational and entertainment purposes, right? There's my disclaimer, right? And, but what you want to do is just, you know, email me. I'll see a reading list and you can figure this stuff out for yourself, because that's what I've done. And, read Creature from Jekyll Island, you know, and, Confessions of an Economic Hitman. I mean, you read some of the stuff I read, you'd be just as, skeptical as I am. And, you know, get the R. Nelson Nash's book, Becoming Your Own Banker, and then go through the bibliography. I just told somebody that today, and because that's basically what I've done. And so The Law by Frederick Bastiat, and you start getting into economics in one lesson. You start understanding Austrian economics, which predicted the boom bust cycle, and you can kind of see what's happening, folks. If you know what's going on, you will know what to do. Stop blindly saying, well, what should I be doing? Because if you don't know, then don't do nothing, and you invest in your education, and which is now you have a clue, and then get with somebody that can have these conversations with you and have you now about the business cycle theory, about demographics, about, you know, because what happens is economics 101, if you've got more people selling stock than buying stock, the price has to go down. So now if your money is predicated upon going up, you know, dollar cost averaging and invest for capital gains, well, that's a problem because, you know, markets go up, markets go down, markets go sideways, right? And so if you're a true investor, you've got to position yourself so that you can make money in all three, right? And so that takes education, you know. And so I want to see what Kiyosaki says, which sounds trite. He says, you know, what is the average person supposed to do? And his answer is, which I completely agree with, don't be average. Okay. And, you know, and take control of your life. Stop looking for other people to do things that you are, you know, you're grown. I mean, unfortunately, I took financial education out of school, so it's really not your fault. But if you've heard even a couple of my podcasts and out there, the information is out there. So you've got to get your head out of the sand and cut off the TV and go figure this stuff out. Because even when I work with people, I say, listen, I'm your guide, but it's your money. Okay. And it can't be more important to me than it is to you. So I am going to give you homework, and if you're going to do your homework, we can't work together because, you know, you need to be aware. So everybody just wants to show up, go to work, put their money in some account, don't even open up their 401k statements, don't even know how it works. You got to be involved. So anyway, I want this to be a 15-minute episode. I'm already at 26 minutes, but listen, reach out. I tell you, a good primer for this conversation is, I know it sounds like a broken record, is the book we have on our site at practicalwealthadvisors.com, which is Financial Planning Has Failed. All right. And we go into between typical advice versus prosperity economics for, you know, the 7 principles of prosperity. So folks, you got to have a decision-making process so that when information hits you, you've got it's like a computer. You got to have an operating system, you know, that you process information and it helps you make decisions, but you got to have a clear vision of where you're going. And then you got to make sure it's like the Alice in Wonderland. Like, well, which way should I go? Where are you trying to go? I don't know. Well, then any road will do. So you have to be clear on what you're trying to accomplish. And then now everything will line up. Okay. And then you won't go off chasing rabbits, chasing down little rabbit trails. You'll kind of stay on your course that you need to stay on, So if you don't have goals, you don't have a direction you're trying to go, you're kind of like out there like a shit without a rudder, chasing stuff, chasing this investment. I see people go into real estate course. I say, well, what do you want to do? I don't know. I just want to, do some deals. I want to flip some houses. For what? I don't know. So I can have some money. For what? I don't know. So I have some money. What are you trying to do? What's your financial independence number? So I kind of work with people like that. So look, all right, I did a workshop at this real estate investment. I said, listen, you've got to have a strategy, okay? Is to become financially independent. Are you properly protected? Do you have liquidity? Do you have your team? Do you have your account? Do you have your real estate attorney? Do you have a good mortgage broker? You need advisors that you still have to lead it, but you still need people that have expertise in certain areas. You need me, Curtis. I'm the quarterback of the team, of course. Right? Just kidding. And no, I'm not kidding, actually. And but that's the thing. So, folks, take control of your life. So, download the ebook. Financial Planning Has Failed. Check your spam if you don't see it. You're going to get a series of emails, and you'll see our newsletters. You'll be on my list, and let's have a dialogue. We're going to start doing. I have a big live event. If you're in the Philly area and you hear this on the 28th of, I'm going to date this, so this won't be completely evergreen. But as I record this. When this show comes out, it should come out, and you'll have a week to go. We're having a workshop with Joe Pantozzi, who's my guest for episode 5, on an introduction to the family banking model. And so if you don't see that, shoot me an email at kurtmay@gmail.com, and I will send you out, it's almost sold out, but it's not quite, and I'll send you an invite to do it. And then what we'll be doing is I'm going to start accompanying little webinars once a month, once a quarter maybe, where I can show the numbers on some of these things, But I just want to be able to have these dialogues with you out here in podcast land. But anyway, listen, you guys have a great day, whatever, morning, evening, whenever you're listening to this. And please, if you like the show, leave me share it, leave me a comment. And let's help this show grow. We really want to help people to understand how to be in control of their life and their money. All right, you guys have a great day. We'll talk to you later.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be granted before syndication or rebroadcasting.